Hello, everyone, and thanks for joining the Landmark Quarterly webinar. As you're all joining the webinar, we'll wait here a minute or two before we get going. With me today, my name is Troy Moliot. I'm the CEO and owner of Landmark Real Estate, and with me is Kim Heisinger, the Director of Property Management. Kim, how are you?
I'm fantastic. Welcome, everybody. I just want to let everybody know that this will be recorded. We'll be sending it out to everybody at the by the end of the day. And then also, if you guys have any questions or comments, feel free to use the chat down at the bottom of your screen, and I'll be monitoring that throughout.
That's great. That's wonderful. Kim, you have some beautiful flowers there. Was it your birthday yesterday, by
Oh,
chance?
it was Troy. And
Happy
was it your
birthday.
birthday last week?
Oh, that's forever ago. Everybody wish Kim a happy birthday.
Oh, thank
So,
you.
well, with that, we're going to go ahead and get started. Kim is going to join us a little bit later to talk about landmark stuff, and I will set the stage. And again, as Kim said, this is all being recorded. So, thanks for joining us for the Q2 webinar at Landmark Real Estate. And Kim, we'll see you in a little bit. Okay, I'm going to share my screen, everyone, and we will get going with our quarterly webinar. So once again, thanks for joining us. Today, we're going to talk about the review of the national multifamily market. We're also going to look at the local Bellingham and Whatcom County market and how that market's doing. We're going to talk about issues impacting the real estate market moving forward. So same agenda as we've done the last few quarters. We're just going to have some updates for you and we'll go from there. So we will do a summary. I'll do an exec summary here for you after I go through a little bit about Landmark. So we will have at the very beginning, if you don't want to watch all of the details, first 5 minutes of this webinar will have everything that you need, or at least an executive summary. Thank you for those of you that are clients that are on the call. Just wanted to thank you for your business and for being a part of our family here at Landmark Real Estate Management. We at Landmark Real Estate Management open doors and help clients build wealth. That is our core purpose. We are proud about that, and that's what we want to do for you as our clients. We have three uniques that make us stand out from other property management companies in the region. We are trusted, structured, and investor focused. We also have some core values that we have on the walls here at Landmark, on mugs that everyone has, and those are that we're problem solvers. We help maintain accountability. We like to serve others first. We do what's right, and we also drive change. We do that every single day. We're always trying to drive change, no matter if it's through city regulations or new changes or new technology. We love to drive change. Our proven process, for those of you that aren't a client of Landmark and watching this, is we will help you optimize the property. We then look at your property and we will manage it. We deliver proven results, and then we help our clients grow. We look for new opportunities and help them grow wealth. And then finally, through our management model, which is what our core focus really is property management. We have a 7-step process that we go through where we market the property, we qualify tenants, we help onboard properties, we collect rents, we collect a lot of rents, we maintain by doing maintenance and a variety of things. We communicate with you and have very open transparency with our clients. And then we transition one tenant out and a new tenant in when housing needs change. So that's just a little bit about us at Landmark. Again, thanks for joining us on our webinar. Here is the executive summary that I will now go through. And this is the executive summary for the 2025 national multifamily market. We believe, we said this in the first quarter, we believe it's the time to buy in 2025. The market is soft right now, and we think it's poised for a move up, and we think it's the time to buy. Bonus depreciation has now been approved at the federal level, and we think that that's going to encourage investors to start looking and buying more and more property. And I'll give you some insights as to local versus national markets as well later. New construction is falling. It peaked back in 2023 and it's been declining ever since. And so that's helping with some of the vacancy issues that we're seeing nationwide. Vacancy rates are at 10-year highs because of all that construction that occurred, and they're peaking this year. So we're seeing that peak now, and we'll start to see that fall off moving into 2026. Existing rents are flat to slightly increasing depending on the market you're looking at, but on a nationwide basis, with new product, we are seeing rents just increase a bit. With similar properties, we're seeing a softening of the market. So with properties that are, I should say, not new, but existing properties. Sales have decreased 65%. They're up slightly in the second quarter versus the second quarter 2024, but for the most part, we're pretty flat right now in the last 3 years. That's interest rate driven. Interest rates, who knows? I will give you some insights and some predictions on where the experts believe interest rates are going. I will point out that they are constantly wrong, but we will go through and look at those expectations. And then cap rates appear to have topped. So again, as cap rates come down, that's better for values. And we'll talk more about cap rates, and I'll give you some examples later in this session. And the price per unit has been falling ever since the peak of the market back in the second quarter of 2022, and it's stabilizing. So that is what we're seeing on the national market. On the local front, in the Bellingham, Whatcom County market, here is an update for you there, our executive summary. New construction has driven vacancies up to over 10-year highs, close to 20-year highs, actually. New construction now is slowing in 2025 and 2026, so we're not seeing as many new properties coming online. That boom that occurred really in 21, 22, and 23 is over. But that inventory is still sitting on the market and has pushed vacancy rates back up to what I would call more normal levels. New construction is harder to pencil with today's rates and costs. Costs per square foot are high, construction costs are high, insurance rates are high, new energy codes high. Everything is making it harder to pencil. And I know many of you that are building or looking to build are waiting for those costs to come down or interest rates to come down. And so that is really the big issue that we're seeing here locally and nationwide. Vacancy rates have peaked and they're starting to fall a bit. And the overall rent per square foot is increasing slightly. It's stabilized this last quarter a bit, but it is slightly increasing when you look at it over the last year. Sales of multi-family properties, actually, there was a huge spike. Really, it's the third quarter. I'll show you there's one sale that just happened in the first week of July, but we have a big spike that just occurred, and we'll talk a little bit more about that. But overall, without that sale activity is down dramatically. Cap rates have topped out, and they're starting to fall. And then new regulations, which Kim will talk about. Man, at the state and local level, we have been a government affairs department, it feels like, for the past year, working and talking to our state and local reps. And unfortunately, we believe real estate owners have really lost this battle. We'll talk about some of the nuances and a few different things here when we get into that here in the middle of the section. So that's our summary. We're going to hop back into the U.S. nationwide multifamily market. A lot of the data I'm bringing you are stats from CoStar, a publicly traded company. A lot of great data and information. 5 units and up are a lot of the data and stats. So we're not necessarily getting single family homes, duplexes, triplexes, and fourplexes in the stats. So it's not a comprehensive survey, but it's the best survey that we have. So what is the nationwide multifamily rate right now in the U.S.? Well, when we've been tracking this back in January of 23, beginning of the year, we were at 6.3%. A year later, at the beginning of last year, January of 24, we were at 7.6%. Then a year later, we were at 8%, beginning of this year. Our last quarterly update, we were kind of flat, right around 8%. And then we popped up just slightly this past quarter to 8.2%. What I'm seeing in some of the data is CoStar sometimes reconcile some old data. So they have, I think, really some of their new data that came in based on vacancy rates kind of pushed everything up. I didn't see anything that dramatically changed that number. Sales absorption is still strong, but again, it's within the margin of error. So right around 8% is where we're at today, but technically a slight uptick on the nationwide vacancy rate. Here is those numbers, graphic. And again, that's the overall vacancy rate. That includes properties with lease up, the numbers I just gave you, these numbers. The blue, and that's this orange line up at the top. The stabilized vacancy rate, so properties without or that are not in lease up, so newer properties, not in lease up, about 6.3% nationwide. So again, there's about a 1.5 difference on that, almost 2 percentage points difference on those overall vacancy versus the stabilized vacancy rates. This just shows you a snapshot, and I kind of track this quarter to quarter, and we look at how many units have been delivered, built in the last 12 months. And this number's been declining dramatically, hence the green arrow down. Still was 601,000, but again, you know, we were 700, 800,000 trailing. So we've been falling off dramatically. That was over almost 1 million units delivered here at the beginning of the year from 2024. So we're falling dramatically, still a high number. The amount of units that are absorbed or rented up of that new product is about 510,000 units. So then that's increasing, which is good. But those, when the amount of units increase that we're delivering versus and the amount of units we're absorbing are below that, the vacancy goes up. So again, what we want is absorption of units to be higher than the amount of units we're delivering, and then vacancy drops. Econ 101. Vacancy rate at 8.2%, and then that 12-month asking rent growth is down over the last quarter, but it's still positive at 1%. So it was 1.1% last quarter, so it's just down slightly. Here is the rent per square foot when we cut through all the beds, baths, studios, 3, 4, 5 bedrooms, whatever it is. We look at rent per square foot. And we're really at a new high with new product, even with all the new inventory. But we've been going sideways for a bit. You can see that big jump from $1.65 up to $1.90 a square foot from 2020 to 2022. That's a large jump, and I'll show you another graph that emphasizes that even more. And we've been going sideways to slightly up. And so we're in that $1.95 to $2 a square foot range nationwide. And this is kind of the long-term trend. We're coming back in line with the long-term trend for really the past basically 7 years. This is a lot on this graph, I know, but just to highlight, here's where we're currently at nationwide. This is the current vacancy rate, shows you, where we're at on a rent per square foot, the growth. But what I like to show you is kind of where we're headed in the US. So this line right here, you'll see this middle section is we're expecting rent per square foot to increase. So by 2029 to be up another, 10%. And so, and you can see where that average rent is, and then you can see vacancy. That vacancy section is projected to fall. So by next year, somewhere in the 7% range, mid sevens, and then continuing to fall. And this is again all of CoStar's projections. Just shows you where we're at rent wise, and so we think that there's some positive tailwinds kind of heading into this market nationwide. This is a great graph that just shows you multifamily housing starts and where we're at, and we look at a T12, which is a trailing 12 months. And really, when you look at where we're at, and the best data we have is a May of this past year, you can see that we're back to like we're at like 50-year lows when it comes to housing starts. Like we're really falling off the table here. We also shot way up, as you can tell, back during COVID and with all the dollars and low interest rate, all the money being pumped into the system, low interest rates. We're correcting, and we're down. We have to go back to 1975 to see numbers at this low amount. So really, really interesting numbers, and that trailing 12 is really falling off the table here. This just shows you the CoStar data. You can see where every bar is a quarterly amount of deliveries of units, and you can see we peaked back in that spring, summer of 2024. And then really construction now is just falling off. And we're falling way down to historic lows right now for new construction. And that'll be positive. So depending on the amount of absorption that we see nationwide, will really vary directly on where vacancies are at. This is apartment lists, so it's a little different resource out there. I follow CoStar, apartmentlists.com, and a variety of different resources. And so apartment list, this just shows you where we're at nationwide. You can kind of see that big rent increase in from 2021 up to 2022, huge increase from, about 1150 a unit to 1400. Big jump. And we've been going sideways to slightly down when we look at the apartment list data. This also takes into account more units other than just 5 units and up. So it's a little bit more comprehensive list. Here's the long-term trend line as well. Back to those, what I would say, trend line support for the past 8 years. This shows you from apartment lists the year over year rent growth. So we're just looking at, our rents increasing. And you can see what happened. This just shows you what happened from 2021 to 2022. We had huge increases, cheap money, a lot of COVID dollars being pumped into the system. People were renting apartments, new apartments coming online. Just the market went crazy, and we're reacting from that locally and nationwide. And those rents have come way down. And so, really, for the past year and a half, we've been below the 0% line for year over year growth. So, again, and this is not on new properties. This is on basically existing properties, their year over year rent growth nationwide. This just shows you the same graph by quarter or by month, I'm sorry. So every bar is a month, and you can kind of see the cyclical part of the season. So the first half of the year is positive. The second half of the year, we start to see rents go negative. So technically, the rents this past month nationwide were up. Really, the last 6 months they're up, but when you look at it over a full year basis, it's actually down. So this just shows you the seasonality by month. And again, looking back to that 2021 year, crazy year of huge growth. When you're having 2% growth per month, big numbers, big numbers. This is the apartment list vacancy rate. They're showing their numbers right around 7%. And again, so CoStar is at 8.3 to 8.2 to 6.3%. So right in the same range. The graph's about the same. The data's a little slightly different, but again, showing you the same trend line. This is a great graph that shows you, based on all that inventory that's been on the market, how many days on the market an apartment is. And so really you're seeing, and this shows you cyclically where it's at by year, but at the beginning of the year, we hit really a 10-year high from days on the market. Right now, this is the spring, summer lease up period. So we're hitting cyclically a low, but historically, this is a very high number for this time of year. We haven't been at this number till really back pre-COVID. So this is where we're at. We believe that this number is going to start topping out, and that the days on the market, or the median time on the market, is going to start to stabilize and even fall. Great graph here, a lot of information, just shows you nationwide what's happening with rents. The red is rent increases, and then the blue are basically the slowest rent increases. And so you just kind of see where the soft markets are in Texas, Florida, the South, Arizona, a lot of areas that overbuilt, seeing really declining rents. Whereas, some of the East Coast, the Midwest, you're seeing some rents increase. And so just kind of gives you an idea of the hot spots and the cold spots in the US on the rental front. Tons of graph. There's so many graphs I want to give you. I have 100 slides. I wish I could give you 1,000, but again, I try to pick out some of the stuff that I always think is the most interesting. This just shows you in the last basically 3, 4, 5 months what markets are hot and what markets are cold. And when you hear of, some of these markets that are really, really being hit hard, Phoenix, San Antonio, Denver, Austin, all markets with a lot of supply, and they are on the bottom left quadrant, which is down since March and really down year over year. And so that quadrant there is really the area where you're seeing the most what we saw, a lot of building, a lot of construction, and really apartment rental rates that are declining. Seattle, the closest market to us, is up year over year, but down since March. And so it's a softening a little bit here recently. The markets that are up since March and really up with the year over year growth, you can see those Miami, Oakland, New York, Chicago, and San Francisco booming. So just kind of some interesting stuff that comes to us from RealPage. This is, again, just showing you again US apartment market rent growth and kind of the increase that we had in the late 2024. And then really we're declining the past 3, even 4 months. We're just seeing that rent growth starting to stall and decrease. Again, that line there, that's only a 1% line right there in the middle. So again, this is just giving you kind of an idea of where we're at year over year. So, US nationwide housing market key stats. Q2 2024 was the top for multifamily construction. And back in 2024, units added, and we've been falling off since. So construction falling, that's a good thing. And that's helping the vacancy rates stabilize nationwide. New permits and construction is slowing 3 quarters in a row. We predict that we'll continue to see that moving forward. Absorption, or the renting up of new units, is strong and increasing despite vacancy, albeit it's still below the amount of units we're delivering. We do predict that in the quarter by quarter, it is falling dramatically. And so we're going to see that year over year really start to fall in the next few months and quarters. Due to supply, the time to lease a unit is really at a 5-year high. Seasonally, it's still fairly low, but again, we will see where that is the second half of this year, and that will really tell us where the market is and where it's going. And rents are starting to increase just slightly, mainly with new product. So let's look at some sale data here. This is sales nationwide. And again, this just kind of the orange bars show you the sales volume by quarter. And you can see that we hit that peak back at the very end of 2021, huge spike, almost 120 billion in one quarter. Whereas, your average is somewhere around 40 billion. We're below that average really for the past 2.5 years. And then the blue line is really that price per unit. So again, price per unit is on the left bar, or the blue line. The orange bars are on the right. That's sales volume. And you can kind of see that, when we had a lot of sales volume, we had high record prices. With lower volume, we've got lower price per unit. So the low is in. And when you look at this graph here, you really see the next 3-4 years. CoStar is predicting that the market and the price per unit is going to increase. So that's why we believe it's the time to buy. And we think that there's some positive factors pushing those forward, albeit with high vacancies. Buying a property right today, I think we're in for some positive territory on the multifamily market. Key stats here. Values peaked back in the spring of 2022. Values have pulled back dramatically and have really appear to be stable and starting to move up a bit. Supply of new units is slowing. With reduced new construction, values will continue to increase and really potentially set new highs in 2027, definitely by 2028. It's the time to buy. So we're calling that, and we called it last quarter, and we're going to continue to call it here the rest of the year. Transaction volume is up from the first quarter of 2024 to 2025 slightly, and then really in the last 12 months. So we're starting to see some buyers on the sidelines starting to come in. Interest rates are the big story there, as many of you know. Sales are still down 60% from those highs back in 2022. So let's talk cap rates a little bit. I've been mentioning these, and I just want to take a little bit of time to talk about cap rates. A cap rate is really that indicator between your net income, what you should be able to take home after we collect all your rents and pay all your expenses. And that net income is before your debt service if you have a loan. And that's that net operating income. It's a ratio between that and your sales price. It's also a way to look at it is really your annual rate of return if you paid cash for the property, if you have no mortgage. A lot of people ask me about this, and I always say you got to buy at a high cap rate and you got to sell at a low cap rate, and that confuses people. So here's an example of that. Here's the formula: the NOI divided by the cap rate. That cap rate is as a decimal. So if you have $100,000 of annual NOI, again, that's take home before you pay a mortgage. That's all your expenses minus off from all of your revenue. If you had a 6% cap rate, that value would be about 1.66 million. If you had a 7% cap rate or needed a 7% annual return if you paid cash, you could pay for that property, or that property would be worth $1,428,000. So again, the higher the cap rate, the lower the value. There's a ratio between cap rate and value, or your rate of return and your value. So as you need a higher rate of return, you can pay less for that asset. Or you need more income. The more income you have, if we had 110 or 120 or $150,000 with income, obviously the value would be higher. But with NOI fixed, looking at cap rates, the higher the cap rate, the lower the value. So hopefully that helps. Many of you have reached out and asked me that question. If you need more information, I have a whole calculator that will do this for you. CREcalculator.com. This analyzes your property for you for free, teaches you about values, cap rates, all the information, free for you guys to use. If you ever have questions, you can reach out to me directly, but feel free to head to our calculator and check out how to value a property. Here are the cap rates in the US. So this is kind of showing you where cap rates are at. And this is CoStar breaks these out by star rating. So the highest quality assets have the lowest cap rates. That low was back in the end of 2021, the beginning of 2022. And you can see that those core assets, those primary assets, those 5-star assets were down below 4.4 cap rate. Whereas at the same time, we were closer to a 5% cap rate for, 2-3-star properties. We have moved up. We're currently in mid-year 2025, and those core assets are now between 5.5 and 6.2% cap rates. So in the nation. So just to kind of give you an idea, CoStar is predicting that they're going to start to soften and and go lower, which will drive values higher. Okay, here's the summary for the nationwide multifamily market. The construction boom has peaked this past spring, in 2024. Rents are flat to slightly increasing. Vacancy rates are peaking right now. Sales are increasing, albeit very slightly, still a long way to go to get back to that 10-year average. Loan to values have decreased from 70 to 80% with 3.5% interest down to 55, 60%. You got to put more money down in order to qualify for a loan. Those debt coverage ratios stay the same with lenders, but with interest rates in the 6.5 to 7.5% range, that's the big story. So not as much leverage. When we can't leverage as much in real estate with people that need debt, there are fewer buyers out there in the market. Cap rates are starting to top out, very interest rate driven, and going to start to decline a bit. And then that price per unit has been falling since the peak of 2022 and appears to have bottomed out, and we believe is going to start to move back up. So that is our U.S. multifamily summary. We're going to hop into the local Bellingham market now. We're about halfway through our webinar. And let's talk about the Bellingham vacancy rate. So what is it? Let's take a look. When we started this back in January of 2023, we were at 2.4%, very low vacancy rate. We hopped up significantly a year later. A lot of new inventory that was being built came to the market. Vacancy rates, this is all properties with properties in lease up vacancy, hit 6.6. We fell slightly a year later to 6.1%. And then we were our last webinar about 6% even. We fell a little bit. With some adjustments that CoStar has made, we're back up to 6.5%. So again, CoStar kind of adjusted some of their data. And again, I didn't see anything dramatically that changed the local vacancy market here, but they're coming up with 6.5%. Here is the graphs that kind of show that data. And you can see that, we peaked back really, we had a huge spike with some new properties that came to market at over 8% with our overall vacancy. The stabilized vacancy market, which really is probably where you really want to focus, we're at about 5.5% today. But we were below 2% on that stabilized vacancy back in 21, 22, and then that new product really shot up that stabilized vacancy rate. Projected to kind of stay flat between 5 and 6%. Many of you are feeling taking a little extra time to lease units. We're working hard here at Landmark to make sure that we optimize and rent your units well, but this is where the market is right now. Here is an overview of the amount of units that have been delivered. This is CoStar's take on the local market. I would say these numbers are not as accurate as the current market. I think CoStar doesn't catch every property that's being constructed or leased up. I talk to their researchers often and try to correct them on things, but again, it is data. I give it some weight, but not 100% of the weight. So again, be careful with CoStar data locally. They're showing 188 units that have been delivered. I think that number was a little higher. And then the amount of units absorbed, much higher at 372, albeit down a bit from where we were a quarter ago. Vacancy rates at 6.5%. And then the 12-month asking rent growth is actually up slightly to 2.2%. This breaks down, this is CoStar's breakdown of that vacancy rate by quality of property. And you can see that the 1 and 2 and 3 star properties are kind of 6.2%, whereas the 4 and 5 star, the newer properties, have a little higher vacancy, almost 8%. So again, blended, we're at 6.5%. A lot on this graph, I know. The yellow line is the US vacancy. The green line is the Bellingham vacancy. So again, we're below the US vacancy rate. And then the bars, the orange bar and the blue bars are absorption of units and how many units we're delivering. And you can just see that in the last really year, those blue bars are pretty low. There's one really large project out in Ferndale. It's 350 units, and it's getting ready to be delivered sometime either at the end of the year or at the beginning of next year. And that's going to spike things up pretty dramatically. So again, CoStar is kind of reacting to that with that green, the vacancy popping up. We'll see how that absorbs. This is the rent per square foot. Again, same chart we showed you for the nation. We're above the nation, and you can see that we're above $2.20 on average. And this just shows you that trailing kind of where we're at. We're very much in line with the historical average, and we're right around that 220, 222, $223 a square foot range. Here's the sale data for the local market, and it was kind of skewed here recently, and I'll talk about that. But in the last, and I ran this just a few days ago, so I caught a little bit of July in it, and you'll see one really large sale that actually occurred on July 3rd. For $50 million. And it's skewing our numbers dramatically. Technically was in the third quarter. But I'm showing it to you today because a few people have been talking about it. It's the Kerf Apartments on Samish Way. It sold for just over $50 million, just closed on July 3rd. 196 units, $256 a square foot. Big sale, skewing things just pretty dramatically. You look at the bar, we have really a record bar sale now. And this is technically the third quarter. So again, when you look at just the second quarter, first half of the year, you'll see is pretty, sales were up dramatically from the previous year, 2024, those first two bars. But the third quarter bar is going to set a new record because of really one sale. So again, just information, good to know. Nice to see some activity. Coast Partners bought that property from the local investor. They bought it below reproduction costs, the Kerf Apartments, and it's a big sale. Here are cap rates for the local market. And again, CoStar is showing that the US cap rates are, above 6, that the Bellingham cap rates are somewhere around 5.6 to 5.8. We're seeing cap rates when they sell probably closer to 6%, is where we're seeing some. We've seen a couple of sales at 6.5 to 6.7. So, and again, then we've seen a few sales in the high fives as well too. So this is where CoStar is showing cap rates and starting to show them soften and start to decrease over the next few years. That's US cap rates. There's the Bellingham cap rates there. And they broke them out by quality rating, pretty close to the same cap rate. Okay, let's bring Kim back in. Kim, hello. Kim's going to talk to us about some landmark stats.
Yeah. All right. Awesome.
Now, we know where the US vacancy rate is. We know where the Bellingham vacancy rate. Where's the landmark vacancy rate?
So we're doing above average with lower than our normal or the national vacancy rate. So we are currently running at 1.6%. That includes properties that are under lease up, so new construction. And so I have a little green arrow on there because we're actually down from last quarter webinar as well. So last quarter we were at 1.9. We're currently at 1.6. So, and then if we take out the new construction lease up, then we are actually at 1.4, and that's exactly where we were last quarter. So staying on that trend, we do tend to see our vacancy rates kind of creep up right around the summer months, just because the majority of the units do turn in the summer. We have a lot of college rentals, and then just in general, most lease terms come due in the summer months because that is the most convenient time for people to move in the Pacific Northwest. Our quarter two average vacancy was 1.66%. Again, that's down from last quarter. We were at 2.17. So this is our 3-month average that you're looking at. So I want to talk just a little bit about pre-leasing because we do have so many units that are focused towards the college students. We actually have 1,323 units that we pre-lease specifically to the college students, so properties near and surrounding Western Washington University. So today we're 92% pre-leased. And what that means is we have renewed or signed new lease agreements for 92% of those 1,300 units for next quarter. So we have a lot of move-ins happening right now and next month. And so college will start here beginning of September. And so we're getting people moved in and making sure all those units are leased and new tenants have signed lease and renewals are signed and doing those in advance. So, and then this year was a bit of a anomaly for us. We actually had 60% renewals, where in the past it's been pretty consistent of 50% renewals and 50% that are vacating, and then we have to release those units. But this year we did have a few more renewals than we have in past years. So pre-leasing is going well for us. So we're staying very busy. So now we'll look at our rental data. So for our portfolio, here is our average price per square foot, and that is broken down by bedroom size. And really, every single one of those categories has gone up just a little bit, other than 3 bedrooms. 3 bedrooms went down by 1 cent from last quarter. So you can see studios average price per square foot for our portfolio is $2.83 a square foot. And then going all the way to your 6 bedrooms, we're getting on average $2.21 a square foot. So the next slide might be a little bit more helpful because it breaks it down if you're looking at it on price, the monthly rent that we're collecting. So, and every single one of those have increased by about 1% from last quarter's numbers. So again, this is average. So just keep that in mind. We have properties that we're collecting much more than this and possibly less depending on the size, square footage, location, age of property, all of that. So but on average, we're getting about $13.21 for a studio, $14.45 for a 1 bedroom, $17.58 for a 2 bedroom, $23.15 for a 3 bedroom, and $28.95 for a 4 bed. So if you have properties that are larger than that and you're interested, reach out to me because I do have that going all the way up to 9 bedrooms. We do have some big houses that we manage.
Crazy.
Okay, so let's talk about some not so exciting news. We've been hit, our industry, with a lot of new regulation in the last couple of months. So at the city level as well as the state. So city is City of Bellingham. So starting with the City of Bellingham ordinance, it did pass. Hopefully, if you're a current client, you received multiple letters and information from us just sharing about that. We have been kind of fighting this battle for the last year. Troy and I have met with city council members. We met with the city attorney. We were part of focus groups. So we actually surveyed our own tenant group and sent a lot of that data to city council, just trying to get this ordinance either dismissed or making it a little bit more reasonable. And I do think that we helped with some reasonable changes with the ordinance, but overall the ordinance did pass. It went to vote strictly with city council. It passed 7-0, goes into effect August 1st. If we currently manage your property for you, we're taking care of all the back end disclosures on the fee requirements, caps, changes to our lease, quite a bit of paperwork and things that we need to be doing on the back end. The biggest thing that's going to affect you as a residential owner, if you have a property in the city of Bellingham, is there are caps now on what you can charge for application fees, security deposits, pet deposits, pet rent, and late fees. Those are the major changes. So a lot of those are capped, which is really limiting your ability to collect kind of what we would say reasonable rates. So they've really, really lowered those significantly. So for example, late fees are 2% of the outstanding rent. And then it also prohibited several mandatory fees. So a lot of like lease violation fees. Let's say somebody has an unauthorized pet. Like you cannot just go charge a fee to that tenant. They have an unauthorized tenant. So the city really wanted landlords to use the current legalities available to them, which really is only an eviction, which we know does not solve any problems. But they really prohibited a lot of mandatory fees that a lot of landlords were charging. And then I just want to point out as well that the city of Ferndale is proposing a similar initiative that's going to vote in November. So unlike City of Bellingham, the city of Ferndale is going to go to vote with the citizens. So that'll be an important topic of conversation for landlords in the city of Ferndale. We'll be sending out more information on that. I guess one good point of the City of Bellingham ordinance is because it passed without citizen vote, it can be amended at any time. So we're continuing to monitor that and get feedback and testimony from tenants and property owners and share that with City Council. So
It's a big deal, Kim.
it
This has
is.
spent a lot of time on this, and as I read these whereas statements, I'm obviously frustrated because we provided them every single city council person, the attorney, everyone with the correct information. You know, the first whereas statement, vacancy rates only 2 and 3%. We showed them where they really are in the greater market. Rents have obviously been coming down with new supply. You know, their goal in this law was to really have one rent and one rent only and no fees. They want everything to be wrapped into rent. So we'll see how this plays out, but you could see, you know, rents start to move up based on some of these additional fees being wrapped into one rent. But the market will determine where that goes.
Yep. Thanks for that. Okay, so then we had two state house bills. So these affect all residential rentals throughout Washington state. The first one was House Bill 1217 that passed back in May, but just a little recap for you. We do have rent caps in place. So there can be no rent increases allowed within the 12 months of a tenancy, even if the tenant is month to month or on a 6-month lease, no rent increases for the first full 12 months of their tenancy. And then after that, annual rent increases are capped at 7% plus CPI, so up to 10%. So there are some exemptions for low-income housing and a small variety of other reasons. And that would be like new building, new construction. So if you've built a new property and the occupancy was in the last 12 years, you are exempt from that. And then additionally, we can no longer charge higher rents for month-to-month leases. So month-to-month leases cannot have material worse terms than fixed term leases, and the rent differences between the lease types cannot exceed 5%. So that's been challenging because most landlords typically don't allow month-to-month rentals because, as we know, you have more wear and tear on the unit. You have more tenants coming and going and rotating in and out, more work on the management side. And so to offset that, to allow, people that are maybe traveling through the area or are in between home sales, we've allowed month to month. But at this point, you can't have a rent difference more than 5% if you're going to offer a short-term lease. And then there's some notice requirements. We have a special form that we must provide for every tenant now on rent increases, must detail the rent increase, the reason, and any claimed exemption. And then the notice provision changed to 90 days. So that's statewide. I can get into additional details. The City of Bellingham actually has a 120-day notice. But again, if we manage your property today, don't worry, we got you covered. We know all the rules and regulations. So. And then just to touch on House Bill 1003, that goes into effect in 3 days, July 26th. This one is a sticky one. So this one now requires, and it links to House Bill 1217, which I just discussed. This one now requires that landlords must attempt a personal serve notice for all lease renewals. So we already do this for evictions. You have to physically go out, attempt to serve to the legal occupant, provide them the notice, and then sign a declaration that you did actually serve the notice. We have to do that now for all renewals. So you can imagine that is a very time-consuming task. We personally believe that this may be amended because it's just a little bit backwards in the new age of email and even text messaging and our tenants all have access to a portal. So at this point, we will be going out to personally attempt to serve every lease renewal that is drafted. And then if we're unable to serve the tenant, we will need to follow up with a certified mail to each individual tenant that lives in the unit. So you have 5 residents residing in the unit, you actually have to send 6 certified mails out individually. So you have to do 1 additional for all other occupants in case there are any unauthorized tenants living there. So again, it's all stuff that we're navigating and taking care of for our clients, but it's some big changes happening here at Landmark and for all landlords in Washington State.
You've been doing an amazing job, Kim, at overseeing all this and dealing with it. I know it's consumed your life for the past several months, but
Yeah.
obviously dealing with it and making sure we do the right thing, even though
Yes.
we don't like it necessarily or agree with it. But we are making sure that, the proper notices are given to your units so that if a challenge were to occur, that we can still get that rent increase. And so a lot of other people are still trying to figure out the laws, the nuances. Reach out to us. We understand it. Kim was literally on the phone before this webinar with one of our several attorneys, making sure we get the exact interpretation on a nuance on one of the laws. We're in direct communication with them and working here for you. So
Yeah.
thanks for all your work, Kim. Thanks for all your work. Oh,
Absolutely.
man. Yeah.
It's been very interesting to navigate through all these changes.
And there's more coming, it seems like.
Yes.
There's more coming.
I know. So I have 2 more to share with you guys. So I just want to let everybody know that the City of Bellingham has a pending initiative. It will go out to vote in November on the ballot. And this initiative, while summarized, doesn't sound problematic. I'm going to just share a couple concerns that we have after digging into it a little further. The initiative is an attempt to prohibit landlords from interfering with tenant engaged in protected activities. So, for example, handing out pamphlets, organizing, allowing tenant representatives to have the same rights and access to the space as the tenants, as well as receive monetary penalties. So that's kind of where our concern lies. Like certainly landlords, as landlords, there are a lot of laws in Chapter 5918 of the State Tenant Landlord Act that prevent landlords from retaliating against tenants. Which is essentially, I think, what people are pro this initiative are trying to say. Like, we just want to protect tenants from being retaliated again. We are already heavily regulated by the state on retaliation. with tenants. My concern with this initiative is it just creates a really broad and subjective retaliation rules. It also states that anytime tenants organize within 210 days after that, you cannot provide them a non-renewal or evict the tenant. We'd also have to allow tenant organization. We would have limited control over who enters the property. My biggest concern is allowing tenant representatives into the building and handing out pamphlets and trying to kind of rally the troops. So, and then also requires some additional disclosures from landlords and posters and common areas and stuff like that. So, if you want to read up on it, it's Initiative 25-03. Again, that'll be going out to vote for the general public. So if it does pass, it will go into effect for a minimum of 2 years. So we'll be sending more information out to all of our clients on that, but I just wanted to spread the word on that one. And then last but not least, at the state level, this did pass. They summarize it as the CBPS, which stands for Clean Building Performance Standard. So this essentially affects any buildings that are over 20,000 square feet. And compliance period is between June 2026 and 2028. And so there's a lot of tiers in between there. So I'm just giving you very general information. We are going to personally reach out to all of our clients that have properties that are affected by this, but there's some significant compliance and recording and benchmarking, developing energy plans, implementing operation and maintenance manuals, and certain metrics that have to be met. And because of all of these things that need to be done, I know June 2026 through 2028 sounds really far away, but it's going to be quite a process. So we've already connected with a couple partners that are kind of experts in setting up this compliance. There is some similar compliance required in the city of Seattle. So again, we've reached out and kind of made connections with some potential vendors that will recommend working with on this. But I do have a lot more information on this if you're interested. But again, if you are a current Landmark client, we'll be reaching out to you individually to kind of discuss next steps and all of the requirements that are involved with that. So
Wow.
that's it.
That's
it.
not much. Not much going
much.
on. Not much going on. Not much coming down the pike. But we've got it. I think you're doing a great job of it. We're hiring. We've just hired a new person as well to really help educate clients, customers, the community as well. Our goal is to be transparent, obviously be the most knowledgeable in the market. And Kim, you're just doing a great job of leading us in that. Whether we like these rules or not, they are here and we're here to interpret it and ideally optimize the properties as we see an opportunity. So.
Yeah. Yeah. And I'm here I mean, I do feel like I'm pretty knowledgeable on these current ordinances and House bills and state laws. So if you have any questions, feel free to reach out to me again. I mean, I can't give legal advice, but we have received a lot of legal advice that we can share that we've received as well. The biggest thing that is concerning with a lot of these ordinances is if you challenge these ordinances or even your lease agreement has language that is prohibited, it's a defense for an eviction. So that's kind of the most scary part because it is already very, very, very hard to do an eviction, specifically in Whatcom County and City of Bellingham, but also throughout the state. And so there are attorneys now that when we do have to go through the unfortunate effect of an eviction are just pinpointing small things in different landlords' leases that are just really slowing down that process. And so that's a big concern. And that's why it's so important that we're following all these new rules. So Anyways, moving on, I just want to, of course, offer if you would like a free market analysis of your property, we're happy to do that for you. Take a look at your rents, give you feedback on rents, vacancies, marketing, other ideas. And so this is for current properties as well as, new construction. We work with a lot of clients that have properties under construction or even in just the very beginning stages. And we're always happy to provide that information to any clients and prospective clients. So feel free to reach out to me. There's my contact information. Again, if you have any other questions, I'm happy to help.
Thanks, Kim. Appreciate it.
Yeah.
That's a lot. Really appreciate you and all that you're doing. So,
Yeah.
okay, well, we will continue on our webinar and just look at the factors affecting real estate moving forward. Should be about another 10 minutes, 15 tops here, and then we'll be done. Interest rates, man. Obviously, everyone understands where interest rates are. I've been showing this graph now for probably 3 years. Here we are. We have, the Treasury, when I looked at it just recently, we were at about 4.4%. That was this morning. We're just below that 5% mark, as you can see. This is a graph that goes all the way back to the 60s. Many of you have told me all the stories back in the 80s of interest rates at 15, 18%. And, historically, we're still reasonable, but there's been a huge shock to the system. That 40-year trend line was broken here back in 2022. And we're feeling the ramifications of debt being more expensive. So, lot to see what happens at the national level. Everyone predicting whether Powell will stay or go or what happens, but we'll let the pundits decide on that. But for now, this is where we're at. Here are the expectations for where the Treasury is going to go, and I just got this. This shows you, where we're at on average, right around 4.3, 4.4. By the end of this year, the experts, whether they're right or not, they've been wrong more than right, are predicting us to be at about 3.86%. And then by the end of 2026 to be down another almost 3/4 of a point to 3%. So they're predicting that the Treasury will start to fall. But again, this is what they believe. Whether it's true or not, I don't know. They've been wrong before, they'll be wrong again, but this is in general the consensus of where the Treasury rates are headed. This is a CPI and shelter inflation. I just think it's always, people hear about inflation and it's going up. It's been a big concern. A lot of people are reacting. Even the laws at the state and local level are reacting to CPI and shelter really increasing dramatically. And this shows you, the blue line is CPI less shelter. And then you see the green line, which is shelter, which is housing costs. And so it was a little delayed. And right now it's down. I mean, it's still cooling, even though CPI is ticked up just a bit. But housing is still cooling off. It's below 4%. Right now and continuing to fall. And I think we predict that it will continue to fall. Most economists are. But this this shows you really what's happened in the market and why new laws are coming up, why people are trying to protect tenants, why they want caps on rental housing. This is what's occurred. This is what's happened right here, and it shows you graphically the effect on the consumer of CPI and housing. Let's talk cap rates and interest rates. This comes from Marcus and Millichap, a great brokerage firm, does a lot of different data, and this just shows you the difference between the 10-year Treasury and cap rates. And this is on all assets, but you can kind of see that top line, that average cap rate of 6.8%. Again, all assets, not multifamily. Multifamily is included in that, but also office and retail and industrial. And then you see that Treasury rate, 4.4%. And so that spread is about 240 basis points. It's been as high as 500 basis points. It's been as low as 120 basis points. So 240 is reasonable. I would say 300 is more in line with where it typically is, and that's the spread between cap rate and the treasury rate. So again, just good for you to understand and kind of see those trends. Obviously, both cap rates and interest rates have been moving up a bit. This just shows you, this is a great graph here that shows you what occurred back in 2020 and 2021. And a lot here happening. And this is just multifamily. This is the rotation to really those local markets. And so the gray line at the very top, that's really those outlying remote markets. The orange line is a secondary market, like a Bellingham, whereas the blue line at the bottom are those primary core markets. And you can see the difference in 2018 and 2019. There was a big cap rate difference from a core market to a secondary market. But what ended up happening is people started moving into those local markets, those Bellingham type markets. They started looking, they couldn't find assets, so they started buying. And cap rates got really close to the same cap rate. And so that compressed dramatically. They actually went down 40 basis points year over year. And so, and it's really, those lines have stayed pretty close over the past 3-4 years, even as sales activity has dropped. So just an interesting trend that, again, I think the core issue here is investors are seeing the primary market and the secondary market very, very similar. And that's good. That's good for our market locally. This just again shows you the apartment cap rate spread across all assets. And again, back in 2018, that cap rate spread between primary and secondary markets was 170, and it's decreased down to 90. And this is the tertiary, or those really remote markets, those small markets. This shows you cap rate ranges on all asset types. So multifamily really having the lowest cap rate range of 4.7 to 7.2, with the average around 6. Office having the hospitality actually having the highest, but office also having a very large one at an average of about 7.9%. So just shows you those average cap rates, the low, the median, and the high. Okay, let's talk local inventory. This is a snapshot just from yesterday of the City of Bellingham Permit Center. And again, we're up just slightly on units finaled in the last 6 months, still down dramatically when we look at where we were last year and the year before. Units under construction are down just slightly from 807 units down to 792. And then new applications in review are also down slightly to 261. 150 of those are multifamily units, 111 of those are single family units. Let's look at the single family sales market locally and then kind of statewide, or Seattle market. So this, I've got two main charts. I've shown them over different time frames as well. The median sales price and inventory. So again, when you look at this, just move my screen down here a bit. When you look at this, you're going to see that the Bellingham market is the green bar. Whatcom County is the purple bar, and then Seattle is the top bar. So home sales are up slightly in Bellingham, nominally, I would say, year over year. This is every bar is a 12-month average. And then Whatcom County is up about 6.5%. When we look at it month by month, you see the volatility every single month. And so you can see kind of where we're at. And really, Bellingham is down year over year by just looking at the month. Seattle is up 8%. And then Whatcom County is pretty well flat. So it gives you a little bit more perspective on the granular level. This just shows you the last 3 years, and you can see that we've pretty flat in the market. So again, large jumps there, obviously from 2014 in single family home markets all the way through 2020, 2021. But really, when we look locally, the last few years, we're pretty flat. This shows you homes for sale. Big story here locally, nationwide. The amount of homes on the market are increasing. Bellingham up 42%, Seattle 36%, Whatcom County 30%. And this is again looking at the last 10 years. Seattle at over a 10-year high, and Bellingham and Whatcom County are nearing 5, 6 year highs, pre-COVID levels, back to those levels. This shows you from all the way from the Great Recession, which is the red square right here, kind of shows you where we were when we had a lot of inventory. You can see Seattle is back to, almost 2011 numbers, whereas Whatcom County and Bellingham are really back to those 2018, pre-2019 levels, really pre-COVID levels. But inventory is building. Inventory, single family home inventory is building. Let's look at that from a nationwide perspective as well too. So nationwide, we're seeing the same thing. And for the first time, we are now we're over 1 million homes active on the market. And that has been increasing since the low in January of 2022. So homes nationwide increasing, inventory is increasing. We're back to pre-COVID levels, again, nationwide. Here is the average sales price of a home, kind of flat to slightly down, depending on how you look at the numbers. But again, huge increase from COVID to where we're at. I mean, huge jump. Under 400,000 on the median home price to over 500,000. Big jump nationwide. Here is nationwide home sales. And again, this is the story. This just came out in Inman News a couple of days ago. I had to take a snapshot. Waning buyer activity pushes home prices growth to a 2-year low. It's a snail's pace out there. So that's what we're seeing. That's the type of media we're seeing. And here's the data from the National Association of Realtors. We're seeing that home sales are they're below 4 million on that trailing 12 months. And so we're just not seeing a lot of activity. That peak was over 6 million, 6.4 million home sales back in 2021 and 2022. And then we started to fall down. So this is the effect of interest rates on sale activity in the US and locally. Housing starts. This is an updated graph up to the month of, the blue is single family new permits being issued, and the red are multifamily 5 units and up. So again, just gives you an idea of, inventory starting to fall, new permits starting to fall a bit and kind of flattening out. So not a lot of new starts occurring, and we're down. And this is one of the final graphs that I love to show you. This just shows you home affordability versus rental rates. And this just shows you kind of where we're at. It's a little dated. I didn't have a current data. It's still back to February, but it just shows you that on the right-hand side, the average home payment to the average apartment rent, even though apartment rents have shot up dramatically in the past, say, 5 years, it's still the cheaper option from a home if you were to buy and finance a home, because that rent payment difference because of interest rates is over $1,200 a month more. So that's a huge delta. It's never been that large in the history of following this data. And so apartments are still a great option for people. That's good for you as a multifamily investor and owner, albeit with the inventory that's in the market today. Whew. So, summary and conclusions. Bellingham and Whatcom County vacancy rates remain lower than the nationwide average. New construction in our area pushed vacancy rates back up to normal levels. Vacancy rates are peaking, even though they made a little bit of a new high here recently. We're still down from where we were at the mid 8% level. So again, they're peaking and we're believe starting to fall. Higher interest rates are going to keep people in their homes longer, and that really will affect the housing market a bit. Housing payment to rent is really at an all-time high, as we just showed you. And the long-term real estate outlook continues to be positive for Whatcom County. albeit for all the new laws that are happening state and local level, we're still seeing a positive outlook from a value standpoint and from building wealth in your investment. So, multifamily sales starting to return. Obviously, we have that big sale locally here, just the 1st of July, and we're starting to see that's positive. Anytime we see sale activity, it's strong for the market and for you as an investor of a multifamily unit. Hey, thank you. Thank you very much on behalf of Kim, myself, all 52 employees here at Landmark Real Estate Management. We just thank you for being a part of our webinar. Kim, thank you again for being our Government Affairs Director here at Landmark for the past year. Appreciate you and appreciate all of our clients that have joined us today. Do we have any questions at all? I know I think you answered a couple.
Yep,
Yeah,
I don't see any additional, but again, feel free to reach out. My email is kim@visitlandmark.com. Happy to help.
great. Hey, thank you everyone who's joined us. We hope that you have a wonderful summer. We appreciate you and your business. And again, feel free to reach out and talk to us about any of your concerns or questions. Thanks for joining us for the Q2 webinar. And again, on behalf of Kim and I and all the employees at Landmark, thank you and have a great rest of your day.
Thanks.